It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. This is the program that takes the mystery out of your financial life. And you know how we do that? We ask that you do just a little bit of work. I know it's July. You sort of feel like you want to goof off, but this work will really help you. All you need to do if you've got something going on in your financial life and you need a little assistance is go to our website. That's jillonmoney.com. On the website, in the upper right-hand corner, there is a little box that says Contact Us. You click the box, you write us a note, and that is the email that we receive. Now, if you would like to join us on the air live, all you need to do is to check the box. Mark will do everything else. While you're on the website, you can sign up for our free weekly newsletter. It comes out on Fridays, and Mark does a great job assembling many of the stories that may have been reported throughout the week that you could have missed. So again, jillonmoney.com, that's the website. Bookmark it, sign up for the free weekly newsletter, and check out all the content that lives on the website. You'll have fun, I promise. Okay, let's get to an email. This is from Dan. And he writes, it probably makes me some sort of real estate heretic to say this, but I have long questioned the value in home ownership. Dan, I love this question already. Okay, Dan says, I've been in my house for 36 years, and I still say that if I had rented all this time and worked someplace part-time for 8 to 10 hours a week, you work on your house, I might be financially ahead at this point. Fortunately for us, after a decade of being relatively plateaued, real estate values have spiked in the last several years in Connecticut. So we may be able to get some cash out when we sell to retire. Your thoughts? Dan, I totally agree with you. You know, it used to be you look at real estate over a long period of time. And I'm not talking about the last 5 years. Last 5 years have been insane with housing prices up like essentially about 45% over 5 years. If you look at home ownership over your 36 years, I think there's two calculations to consider. One is, hey, what would your rent have been, right? And also, what would have happened to the money that you put into your home as a down payment, as maintenance, as your property taxes, all that stuff? What would have happened to that if it were in a, 60-40 or 70-30 portfolio? Right? So that's one thing. And then, of course, you're absolutely right, which is the amount of work that you put in on your home is also like that's the sweat equity. Would you have been better off somewhere else? So I don't think owning is for everybody. And I also think one of the greatest Uncle Sam giveaways in the entire tax code is this bias towards home ownership, which I think, frankly, Dan, if I'm a heretic, I'm going to say it out loud. I've said it before. I think it's ridiculous. I do not think you should be able to deduct home mortgage interest on your taxes. I just don't. And I don't think that you should get any sort of advantage over someone who is a renter just because that's the choice you've made. So I'm kind of with you. Heretics unite. Thanks for your note. Really appreciate it. Okay, next up, Jerry writes, I have a family member who lost her husband about 5 years ago. She lives in California. She did not want to lose the $250,000 in the tax advantage, so sold their house. She didn't like the neighborhood anyway, right at the 2-year anniversary mark of the death. She has approximately $3 million in various savings accounts, lots of cash on hand, plenty of month-to-month income with approximately $7,000 a month in expenses. She is in high-risk investments. At age 70, she's renting a nice home, and she desperately wants to buy another home, but she's only in her home about 15 days a month because she's still a flight attendant. Wow, that's amazing. 15 days a month. She travels a lot for work and family, so she's rarely at home in the house. I'm not privy to the details of her investments, but I'd love your opinion about whether or not she should buy a home or continue to rent. She has a lot of quote unquote things that require a big house with no intention of downsizing, would prefer to stay in Southern California. What are your thoughts on the big picture? Buy or continue to rent? Thank you. Love your show. Jerry, this is so funny because this is just like the previous note from Dan, which is, I think in this situation, renting is a no no-brainer. I don't know why you would want to take all this money that you have, $3 million, and plunk it into a house where you're only in that house half a month anyway. It makes no sense to me. So I think renting is great. I think that she may also want to even think about her riskiness when you say she's in high risk investments. Not sure that's the smartest thing either. So I think what we would really look at in her case would be, hey, if she's happy and she's got cash flow and the rent is reasonable, which it sounds like it is, stay where you are, Jerry's friend. Do that. Okay. This is from Rich, who writes, I've got a question about high yield dividends and reinvestment. Hi, Jill and Mark. I have invested in a mortgage REIT that pays an attractive 15% dividend yield. Okay, guys, just one quick thing. When you're a REIT, a real estate investment trust, they have to distribute a whole bunch of money to you. That's kind of the rules of being a REIT. It's pretty huge. It's paid monthly, not quarterly. And he says, I've put 1.5% of my total assets into this one mortgage REIT holding. I watch it daily. That's a lot. Daily's a lot, man. And so far, the share price has risen by 8%. I figure if it falls back and starts to go below my purchase price, I can decide to ride it out or sell. If I sell, then I will have gained the dividends until that point. I am now thinking about whether to do dividend reinvestment. Originally, I thought of taking the dividend and either withdrawing it or adding it to our cash reserves, or maybe using it to buy something else every month, even though the number of shares might be small each time. Do you have a perspective on reinvesting dividends while I watch the share price? To me, it seems like a great way to keep accumulating and growing, but I'm not an expert in this area. Last thing, I'm only investing an amount of money that if it went to zero, wouldn't change my life drastically. Thanks, as always. You know what? I think in this case, REITs move around and the dividend yield changes based on, you're not getting 15% all the time. You're getting 15% based on what the price was when you purchased it. I think if you're going to do it, why not reinvest the dividends and make it easy and stop looking at it daily? That's nutty. The one thing I will say is if you want it, like the share price has risen by 8%, great. But if you sold it, you'd have to pay capital gains, short-term capital gains on it. So I think unless this is held in a retirement account, stop messing around with this. Just let it be. Make it part of your portfolio. And that's it. Leave it alone. I don't understand people who look at stuff every day. Like, don't you have better things to do? Okay. Gary says, should I collect Social Security now, even though I don't need it? Gary says, I'm 68. I was planning to wait until 70. But I am concerned about the shortfall, meaning Social Security Administration shortfall, and the potential for means testing, specifically for people not yet receiving benefits. Okay, well, if it's 2 more years, I wouldn't worry about that because I don't think there are going to be any changes to Social Security in 2 years. So I think you can wait till 70 and you'll be fine because the changes that have to happen to Social Security are probably going to happen like in 6 years. And I'm not sure they're going to do means testing or not, but you get 2-year period, no sweat. The only changes to the tax code are the ones being contemplated in Congress right now, and there are no implications for Social Security that impact you. So, Gary, wait your 2 years. That's my 2 cents. If you have a question, just get in touch with us by going to JillOnMoney.com, click the Contact Us button, and write us a note. You're listening to the Jill on Money Show. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. Let's talk to Cheryl and Harry from New Jersey. Hi, Cheryl and Harry. What brings you to our airwaves today?
Hi there. Well, we're a retired couple. Harry's 75 and I'm 74. And we're trying to keep ourselves going for as long as we possibly can. In looking into moving some cash, we spoke to an advisor who mentioned whole life insurance with a long-term care rider.
Oh, okay. Okay. That is an interesting product. And I know that a lot of people are considering it. Let's go back a step. So you guys are retired. What is the source of your income right now?
The source of our income is that we both have pensions.
Ooh, you sound like a very
Sweet
good looking couple with those pensions.
Oh, sure. And that and pensions and Social Security is a source of our daily income. At this point, in terms of our actual money right now, we have total assets is about 650,000.
Okay.
We have about 300,000 in cash or CDs.
Mm-hmm.
And one of the things that we're considering doing is moving some of that cash into an annuity with a fixed interest rate.
Okay. So the 300 grand in the cash and the CDs is part of the 650,000 total, right?
Yes, it is.
Okay. And the pension and Social Security, what is your total income for the year about?
The income on our last income tax was about 180,000.
And how much do you spend of that 180?
Well, we get, just in terms of what we take in, we usually, our take home every month is about 11,500. And we usually save about $2,000 a month.
And is that how the cash built up?
Yes, the cash builds up. We are fortunate to be able to regularly save. We save
That's
every
amazing.
month.
Okay. So when you said the 650 total, 300 in cash and CDs, where's the other 350? Is it in retirement accounts or brokerage account? Where is that?
We have 155 in a money market, 80 in another savings account. So that's total cash. Then we have two CDs, the total about 75,000.
Okay.
Then we have a $111,000 annuity.
You already have an annuity.
We do have one, yes, and we have another one for another 111,000. And then Cheryl has a retirement account with about 117,000.
Okay.
Depending on what day the market is.
Okay, we'll take the about. And that retirement account and the two annuities, are those retirement annuities? In other words, was the source of the 111,000, did it come from a retirement account?
No.
Or did it come? It did not. So they're non-qualified annuities, meaning after-tax money.
Exactly.
The retirement account is 117,000. That has not been taxed yet.
Right.
And that you are now you're withdrawing, right? You've got minimum required distributions going on from that account.
Exactly.
Okay, and that's the only RMD account that I have to worry about, right?
Yes.
Okay. So next question: house. How much is your house worth?
Probably close to 400,000.
Okay. Is there a mortgage that's outstanding on it? No mortgage.
No, there's no mortgage.
Any other real estate?
No.
Okay. Grown kids, no kids, what's happening?
We have 3 grown kids, 7
Doing okay?
grandchildren.
7? Wow.
And our children are happily independent.
Well employed.
Well employed, yeah.
I love that. I love well-employed children. You did a good job, or you got lucky. Either one.
Thank you. That's
We'll take both.
Right.
Okay. So the fact that you already have 2 annuities would almost be like the suggestion out loud to me is why another annuity? In other words, when did you purchase those 2 annuities, those non-qualified annuities?
One was in 2021, I believe.
Okay.
2022, I think we basically, just to give you an idea, the 5-year comes out next January and the 3-year actually comes out this August.
So those 2 annuities are now going to be done?
Yes.
Yeah.
So in other words, in addition to that big pile of cash, there's going to be something like $225,000 of annuities that are going to be flowing out. Is that right?
Right. Unless we renew them as annuities or something. Yeah.
Right. Let's not do that. Okay. So, and of course you'll have to pay some tax on those, right? Okay. So, which is fine. Is there anything on the horizon that gives you pause about your financial life? Like it seems to me like you make a lot of money. You've got pension, Social Security. You're saving $2,000 a month, which is incredible in your 70s to be saving, to be net savers. Is there anything that is out there that is worrisome to you?
Just the possibility of a need for long-term care,
And also the fact that all of our healthcare comes from Harry. So if something were to happen to Harry, I would have no health care.
Well, I mean, you mean that you would have
No health care.
Medicare?
Yes, I would just have Medicare, right?
Okay. So you got me nervous. I'm like,
I'm sorry.
why?
No.
Did someone take away our Medicare system yet? Not yet.
Possibly.
It's still with us. Right. Okay. So it's interesting. I understand that it's a weird thing. Okay. So what happens if Harry predeceases Cheryl, then you lose this extra coverage of medical, but would you get a portion of his pension?
I would not.
Okay. So what you would lose would be how much? Are the pensions about equal, or are they sort of
No.
No.
Harry, what's your pension?
About $6,000 a month.
Okay. And Cheryl, what's yours?
It's about $2,100.
$2,100. So to me, there's the risk, right?
Right.
Harry passes away. You get zero of his pension.
Right.
You lose some health insurance. You are now surviving on your pension plus, some Social Security and survivor benefit, but it's probably not enough to really float all of your expenses. Is that right?
Right. We did forget to mention that Harry does have a term life insurance.
How much?
He's 82. It's $500,000.
Harry, I don't want you to die before you're 82, but that still does leave a gap.
Yes.
Right? Okay. This is interesting. I think that some of these products are interesting that have long-term care riders. So when you looked at the whole life policy with the long-term care rider, did you do that? Do you manage your own money, or do you work with an insurance person, or how are you managing things right now?
We do have an advisor. He's the one who mentioned at our bank, and he mentioned the long-term care. We have not gotten any details on that in terms of costs and whether they're eligible or anything. So we kind of wondered, from your point of view, what would be the things to look for?
Well, I think there's two things. Number one is, I think that if I were looking at this situation objectively, I would want somebody who is not compensated by the insurance company to do the analysis. So that's number one.
Okay.
So what I would do is I would probably pay somebody out of my pocket right now to do that analysis for you. And when we get off, I'm going to have Mark send you the name of somebody who I know in New Jersey who is a fee-based advisor, meaning no commissions, no nothing, to give you an objective picture of this situation. Because the complexity of it does not come from the today. It comes from what happens if Harry dies after age 82, which he, I hope that he doesn't die before that. But that could put Cheryl in a little bit of a bind. And, it's a weird thing because you have sort of a double whammy risk. One is if Harry got sick and then depleted some of your nest egg, your $600,000 or $700,000, right? Then it leaves you, Cheryl, with a lower base of assets to draw from to survive your own life.
Right.
But I'm not sure if the best product is a whole life with a long-term care rider, or if a better product might be to take these annuities and roll them into something else that would also have a long-term care rider. You're listening to the Jill on Money Show.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
Welcome back. It's the Jill on Money Show. We are here trying to help you navigate your financial journey. We do that by asking you to do a little bit of work. Just go to our website, jillonmoney.com. and click the Contact Us button, which is in the upper right-hand corner, no matter where you navigate on the website. Write us a note, and if you'd like to join us live, check the box. Mark will do everything else. Hey, while you're on the website, I encourage you to subscribe to our 2 other audio programs. There are 2 podcasts. One is called Jill on Money, which we release every day, Monday through Friday, and the other is called Money Watch, which is on demand for Saturdays and Sundays. And with Money Watch, we do a little bit of a deeper dive into some of the issues that you may need some refreshing on, or maybe you're just starting out on that journey. So check that out. Jill on Money podcast and also the Money Watch podcast. You can get them wherever you get your podcasts or right on our website at jillonmoney.com. Okay, let's get back to you. Next up, we've got Max, who's on the line with us from New York. Hello, Max. How are you?
So I am 45 years old. My wife will be 45 shortly as well. We are both teachers, and we kind of just want to know if we're on par to retire at like 55 or 57.
I said you're from New York, and since I'm familiar with the New York State pension plan for teachers, are you in that plan?
Yes.
Oh, fabulous. You're probably too young. You're in like tier 3 or 4. Is that right?
Tier 4.
Tier 4. Got it. Okay. Both of you. So how much money do you guys each make?
So I am at 145 and my wife is at 110.
Amazing. Do you guys have kids?
Yes, we have a 14-year-old and a 10-year-old.
How long have you guys been in the system, the New York State system?
So I am 23 years and my wife is 20 years because she taught in Jersey for a couple of years first.
Listen, we're not going to hold it against her. So at age 55, in 10,
I do all the time.
in 10 short years, what will each of your pension benefits look like, approximately?
So if I go at 50, well, here's the thing. So I want to go at 55. She tells me I can't because she can't go till 57. So I'm assuming I'm going to go at 57.
Okay, but you can give me the 257s. I'm sorry, I laughed about that. She told me no. What's the $57 amount?
So with the full like 100% benefit, like, if I, die or whatever,
yep.
I'm 113 and she is 70.
Oh my gosh. Okay. Can you guys live on $200,000 a year?
Yeah.
So that's not a
I
problem.
think, yes.
It's amazing.
So here's
what
my
else?
thing. So
tell me.
I have fantastic parents who do a lot for us. They like to treat us to things. They like to take care of the boys. So I kind of want to be able to do those same things. So I guess I say, 200, but, vacation every other year for like the kids and grandkids, just kind of want to make sure, we can do all that. Like when you retire, obviously less comes out of your check,
right,
which I get.
I mean, you have great benefits. Let's stop for a second. You have amazing benefits.
Okay.
And at the very least, the 200, it'll be taxed. You're going to have great health care, not a problem, but that'll pay your basic bills. So let's go into what other money you have saved. Do you guys both have 403Bs?
We do. My wife didn't really do a lot of hers because she had a Roth that she was doing.
Okay.
So she has 270 in a Roth.
Okay.
I have 175 in my 403B.
Uh-huh. That's traditional, your 175?
Yes. My district did start doing a Roth, which I am now doing. So I'm now doing a Roth.
Okay, good.
We have a 529 with 102. Then we're at like 30,000 regular savings.
Okay, that's great. This is awesome. How about the house?
Our house, which should be done by November, December, we have like 30 left on it. It's worth about 725, 750.
This is a house you're going to stay in? I mean, because your kids are in a district, right? Like we're not moving around, right?
No, I'm not allowed to.
Okay, I like that I like the rules that are in place. So by the end of the year or something, like we're early next year, when you say the house is going to be paid off, at that point, what will the expenses be? Just the general expenses that include all the fun stuff that you like to do.
About $9.
$9 a month. Okay. And when you look forward and you say, okay, look, it's 10 or 12 years, you're going to keep socking money away. When you say, I want to do some fun things, what do you think in today's dollars, what would that look like for you? Like, would that be like you want to do, like, I want to take like my kids and whoever they're dating, we're going to go on a big vacation. Is that $20,000 a year in today's dollars? Is that $50,000 a year in today's dollars? What do you think are the extra fun things that you want to feel like you can do? Maybe not every single year, but every so often, what do you think the amount is?
Probably 20.
Okay.
About 20.
You are right now, you're living this life. You make a lot of money, right? I get it. You live in a high cost of living area. I understand that. What is the amount that you're putting away in your, like for the two of you, what amount are you putting away on a monthly or annual basis into these retirement accounts?
I just started maxing mine out probably like 2 years ago.
Okay.
We don't do a whole lot to her Roth.
Okay. So right now you're putting in the maximum, the 23.5 into your retirement account, right?
Yes. Yep.
Okay. And let's pretend that's all the saving that you do for retirement, that her 270 is stagnant. You don't add any money to it. Your 175, you're adding 23 grand a year and whatever it ends up being, right? Going forward. Okay. Mm-hmm. Are you also putting money away, additional money into the 529 right now on an annual basis? Or is that kind of are you done at this point?
No, we do $300 a month, which I wanted to bump up once the mortgage was done to $600 a month.
Okay. Do you think that these kids are SUNY, State University of New York kind of kids? Or are they kind of like, no, I want to go to Stanford or wherever they're going to go?
So funny you asked that. We are having the conversation now with our 15-year-old. He gets it that SUNY makes the most choice. And we've said to him, if you go to SUNY, you're probably not going to have any college bills. My nephew is a freshman at a very expensive university, and I see the struggles that people go through.
Yeah.
So, hoping SUNY.
Okay, good. We'll get back to Max in just a second. If you've got a financial question, any sort of change going on in your life that's impacting your money, get in touch with us. Just go to our website, JillOnMoney.com, and click the Contact Us button. You're listening to The Jill on Money Show.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Welcome back. It's the Jill on Money Show, and we are trying to help you figure out what is the next step you might want to take in your financial life. Now, this means something very different for each one of you, and that is why I encourage you to get in touch with us directly by going to JillOnMoney.com and clicking the Contact Us button. You can write us a note, or if you'd like to join us live, check that box and we'll get you on the program. Each of you has something that is distinct to you. And so while I know that many of us are voyeurs, we love to hear other people's stories, if it's something in your life that needs attention, we would really love to hear from you. Anything from changing jobs or careers, or maybe you're buying a home or selling a home. Maybe you're thinking about how to navigate your kids' college experience. Maybe it's about your own retirement. Whatever it is, we really would love to hear from you, because this program is all about you and what is going on for you. Right now, let's get back to Max from New York. Mark Talercio, who is listening in on us, if these two kids are going to go to SUNY schools, and we've got 4 years for one kid, right? And then 8 years for the other, how much money do you think has to be accumulated in that 529? Because here it is, 100 grand. It's a lot of money. How much more money do you think has to go into that plan?
Well, I think more. I mean, I think, 100 grand is a lot of money if you're talking about one kid, but we got two kids.
Yeah.
They're fine. They have huge pensions. They already have nearly $500,000 saved. They're going to continue saving for the next 12, 13 years. So by the time that comes, that account's going to be over $1 million plus the pen. They're fine. So I think the 529 for me is the focus.
So, Max, how do you feel about that? Like, if you have, first of all, I also want to reiterate before we move on, that you are in great shape. Whatever you think you should have done or done, that doesn't matter. You have two teachers who are living within their means. You've saved money. You're doing a great job. Nothing bad is going on here. In terms of your future and being able to have I want to be able to have that fun vacation. and spend the equivalent of 20 grand every couple of years on something big, like that's awesome. You can do that. You'll be able to do that. That's not going to be a problem for you guys. It really isn't. I agree with Mark. If you're an educator, so I know education's important, but I think that we're going to have to put a little bit more money into the 529 plan. And even if you told me that your wife was putting a lot of money away into retirement, I wouldn't even suggest that. If your cash flow allows, when that mortgage payment is done, what's the actual mortgage payment right now? What is the amount that you're paying?
So you're going to laugh. I don't even remember what my original payment is.
Yeah.
Because all I know is that I've been paying extra. So we're going to finish a 30 year in about 9 years.
Oh, so you have a lot of money. This explains a lot. Okay, so here's what my guess is.
I'm that person.
Okay, but
I'm that person who wants it out of there.
Okay, so I think once the mortgage payment is done, you said you're going to go 300 a month up to 600 a month. I want you to watch the cash flow, but my guess is you can put $1,000 a month into the 529, and that's what I would do right now. I mean, when the mortgage is up, and then you're fine, and then you're done. And then look, if you oversave for 14-year-old's like, oh, I'm going to SUNY, blah, 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 and it's great. And you can use the money between the two kids. You can, if there's anything left over, you have that 35 grand that you can pop into a Roth IRA for the beneficiaries. You're in great shape. This is all good news. And when you retire at your age is 57, right? At that point, both kids are done with college. Do you think you're going to stay in the area, or are your parents close by? Is that important to you, or do you think you'd go somewhere else?
So, yeah, super important. So my parents, my sister, my nephews, we're all within a half hour of each other.
Oh, nice.
So my parents watched both of my kids before school started, both of my nephews at the same time. So they grew up together.
Oh.
So ideally, that's what I'm hoping happens, in my future.
You're in great shape. Do you guys have your beautiful estate planning documents done?
We have our will. We just haven't signed it and sent it back in yet.
Because why, you want to see if you got a better deal somewhere? No, just kidding.
No, we get it. I got it free through my school district. So that's one of the things my district provides.
Amazing.
We've just been dragging our feet.
All right. Well, look, you're in great shape. I think your 12-year plan is a great one. Thank you for being an educator, because it's important. And for everybody who's listening and all these people who are like, oh my God, these teachers, they make so much money in New York. Well, because in New York, it costs a lot to live. And so they have to pay their teachers more. I bet, Max, where you live in your neighborhood, the kind of folks that you're around, they make a lot more money in their salary or their total compensation, but nothing like that pension, man. That can really figure into amazing retirement plans, can't they?
Yeah, and I've really been just kind of thinking about it the past couple of years, and I'm like, wow, okay, like it's going to be good, I hope, So
yeah, it's going to be great.
You've said all this, I feel much better.
It's going to be great. So listen,
Can I ask you one other question?
Yeah, sure, absolutely.
Because we're going to have these pensions, are we going to really kind of pay a lot of taxes when we're older?
Yes.
It's like, should I start doing more Roth than 403B?
Yeah, absolutely. It should be all Roth.
Okay.
Okay. I mean, it's not going to be so terrible.
Because I can do 23.5 Roth.
Yeah, just do it. Just do it, because
okay.
She's got the 270 in the Roth. That's not the problem. But yeah, do it all, and then you'll have. Hope maybe by the time you retire, you'll have about the same amount of money in a traditional and a Roth, and that's great. That's perfect. Don't worry about it. If you've got a financial issue that you'd like to discuss, just get in touch with us. Go to JillOnMoney.com and click the Contact Us button. Don't forget to check the box if you'd like to join us live. It's so much fun. You're listening to the Jill on Money Show. You're back. It's Jill on Money. This is the program that tries to take the mystery out of your financial life. We do that by answering questions that you pose to us. If you've got one, all you need to do is go to our website, jillonmoney.com, and click the Contact Us button. When you write us that note, that is the email that we receive. And, we do emails because we know there's a bunch of shy people out there, and we want to make sure that if you don't want to join us live, that you have an outlet. If you are going to send us an email, please make sure you give us a lot of the details so we don't have to say, follow up with us with the details. And so that is what Mark did. And he writes that he is 65 years old and retired. He says, I have monthly Social Security of $2,600 and monthly expenses of about $2,600. Wow, that's pretty great. And remember that Social Security is indexed for inflation, so it's nice that you can keep up with the overall inflation rate. Mark also has $900,000 in short-term CDs and about $600,000 in annuities. He goes on to say, my 3 children are on their own financially and I am divorced. Do you think that I should be more aggressive with my savings? For example, maybe I should move some money from my CDs into the markets. What do you think? Well, Mark, I do think that it is really helpful to have some portion of that money that is invested because, again, you want your money to grow. I know you want to have some stability by having CDs, but you've got so much money now that having some portion of this invested in the financial markets, in stocks or stock index funds, I think that might be helpful. The question is, what portion? And for that, I'd really have to know more about who you are in general. Like, do you have an aversion to risk? Is that why this $900,000 is 100% in CDs? And also, I'd like to know a little bit about those annuities. Are they fully invested in stocks, or are they also in the lower risk fixed income type of investments? Let us know, and then we can better guide you. If you have an allocation question or any other question that's on your mind, don't forget, all you need to do is go to our website, jillonmoney.com, click the Contact Us button, and we will get your note. You're listening to the Jill on Money Show. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's the Jill on Money Show. We are here trying to help you make better, less bad financial decisions. Now, if you've got a question, or maybe you seek some guidance, some mentoring, some coaching, just get in touch with us. Both Mark and I are certified financial planners, and we love to talk to you about whatever is important to you. Go to our website, jillonmoney.com, and in the upper right-hand corner, you'll see a Contact Us button. Just push that button, a form will pop up. That is the email that we receive, and just give us a bunch of details so we know how to best help you out of whatever you're confronting. And it doesn't have to be a problem. It can be a good thing. It could be excitement over a big raise or a new job. Anything that's going on that actually touches your money in any way, we'd love to hear about it. Again, jillonmoney.com. While you're on the website, check out our service called Jill on Money Live. That's where you have access to quarterly live webinars, the back catalog of those webinars, bonus audio and video content, all for $45 for the next 12 months. Jill on Money Live. Right now, let's take an email. This is from Michael. I'm following advice that I hear about all the time, which is make sure you have an emergency fund with about 6 months of living expenses. That's good advice, and I give it all the time myself. Okay, so Michael and his wife have done so. They've got $70,000. It's in a Schwab investor account, but not quite sure how to make the money work for us to keep it liquid. It is gaining minimal interest. I feel like we should be doing something smarter with it, but I also feel like we need to be able to access it when or if needed. Recommendation on the type of fund that will help make it grow, but also keep it liquid. Let's look up at that Schwab investor account money market. Let me just look up Schwab investor account money market yield. Let's see what you got. So at Schwab, if you're just like in sort of a plain old account, you might be getting trash in terms of your interest. Like it says here, uninvested cash in your Schwab brokerage account. This is how Schwab makes money from you, gang. Uninvested cash is paying 5 basis points. Got that? 0.05%. However, at Schwab, guess what they have? They've got Schwab money funds, and you can earn somewhere between 2 and 4%. Let's see what they got here. I'm just looking here. You can buy the Schwab Prime Advantage Money Fund for 4.12%. So you can keep your money where it is, getting basically zero, or move it. And you have to do this. They're not doing it automatically for you. This is such a scam for these funds. I just can't even believe it. I do, but I mean, honestly, so silly. If you also are interested, you can buy CDs from Schwab. And this is by FDIC banks. Let's say for you, you want to say, I want to keep some money liquid. You could maybe build a little bond ladder, right? So maybe you'll do like 18 months and you can stagger it. Maybe you do like a 1-year CD for 4.35%, maybe a little in a 9-month and a little bit of money in a 6-month. And then it's locked in and you can re-up. But you must proactively do something with this. Otherwise, you are not going to earn any interest. Okay, Michael? So I hope that helps. All right, this next question is from Grace, who writes, Hi, Jill. I'm a big fan of your show. I am asking a question on behalf of my relative. I love this. This is the classic asking for a friend. Okay, so Grace's friend is a U.S. citizen who lives abroad and has done so for most of his life. And so he's never paid into Social Security. So he's 45 years old. Does it make sense to pay into Social Security now? Appreciate any pros and cons and other thoughts. Thank you. Okay, well, Grace, first of all, he's got to have a job that would count. So I don't know if he's getting paid from a U.S. firm or not. Let's just pretend Grace's friend lives in the U.K. Then you're getting paid by a U.K. firm. You can't even pay into Social Security. So you have to be working for a firm where or get earning income where you claim some part of it where you can pay into Social Security. That's number one. But yeah, I mean, if you're 45 and you can work for 10 years, accumulate 40 quarters of credits, sure, why not? The downside is that you got to pay, you got to pay your chunk of money into the system. But, I like Social Security, even if it's going to be smaller or different. I think that would make sense, but we'd have to know more about your friend. Stephanie says, Hi, Jill and Mark. I've listened to your show for quite a while. I made the leap to be a stay-at-home parent 2 years ago when my partner got a promotion. We're doing okay financially. I'd love some guidance on our retirement contributions in comparison to our cash flow. Before I started listening and learning about personal finance, I shoved all of our savings beyond our emergency reserve fund into a 12-month CD. Okay, it's coming due at the end of the month. And we are debating how much to tuck into 529s for our 2 kids. And if we can take a nice Hawaiian vacation for our 15-year anniversary. Please know I'm so grateful for your show and that you've helped me know that there are better things I can do than shove everything into a CD. You guys rock. I love listening to both of your shows. Oh, thank you, Stephanie, because both shows mean she's also listening to Money Watch. Okay, so Stephanie, now that you know you've got your emergency reserve fund, now you've got this extra money. My next question would be, are you putting money into retirement? Because maybe you could use that 12-month CD and the proceeds from that to fund, say, a spousal Roth IRA for you. Again, I don't know what other stuff you're doing, but if you're looking to tuck money into a 529 and you're looking to blow the money on a Hawaiian vacation, I'd leave that to you. I don't know what your others, what else is going on, what your cash flow looks like, what your partner's income is. If you've got that emergency reserve and you don't have any consumer debt, are you maxing out your retirement accounts? If the answer is yes, you're doing that already, then maybe I would use that 12-month CD to help fund the 529s. And maybe you can split the difference. I mean, look, if you are willing to forego your children's future for your vacation, I'm all in. Is that a mean way to look at it? But it's kind of the truth. So it's not like just one or the other. Maybe you can do a little bit of everything. So get back in touch with us. We would be delighted to walk you through this, okay? This is from Susan, who writes, My husband and I are getting up there in age and we have no children, and our immediate heirs are doing fine on their own. We would like to set up a donor-advised fund for our own charitable giving during our lifetime, and then would like to name our nephew as the person who oversees the fund after we pass. His values are very aligned with ours. Is there a way to do this without involving him with the tax burden of the money? It would not pass to him personally. He would just be in charge of distributing it. This is a great question, Susan. So as a reminder, a donor-advised fund is a fund that you can establish with pretty much any major investment house like a Fidelity, a Vanguard, or even one of the big wirehouses. The way a donor-advised fund, or a DAF, works is that you can contribute money into the fund at any time. And, any year, you can skip years, you can contribute cash or low-basis stock or mutual funds, and it provides you with this wonderful ability to contribute when you want to, take that tax deduction when you want to, and then distribute the funds over time in the future. Okay, now to Susan's question. When you have these funds, obviously you're putting money in and they're yet to be distributed. So if you pass away, there are a few different options. An easy thing to do is to name one or more individual, like your nephew, as a successor. And then this person can carry on your charitable legacy until the funds are depleted. Now, the one thing that's important about this is you must make sure your nephew knows that you're doing this. For those listening who don't have someone they can name, you can always name an organization that you have given to in the past as the recipient of the funds once you do pass away. If you have a question, just go to JillOnMoney.com and click the Contact Us button. You're listening to Jill on Money.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. It's the Jill on Money Show. We are here trying to help you navigate your financial journey. And, we're sort of like Waze for your money or Google Maps for your money, because all of us know somewhere inside that there are a lot of different routes to consider to get where we want to go. Maybe the problem that you're facing is you know that there are all these different routes, but you don't know which one seems the right one for you. If that describes the situation you're in, or maybe you don't even know what routes are available to you, get in touch with us. Go to our website, JillOnMoney.com. Click the Contact Us button. Write us a note. Let us know what's going on. And if you would like to join us live, then just check that box. Mark will do everything else. While you are on the website, I encourage you to check out our two other broadcasts. They are called podcasts: Jill on Money, Monday through Friday, and Money Watch, which airs on the weekends. So all of the links are there on our website. Very easy for you. I promise it will not be a very difficult lift for you to go there. Right now, let's get to an email. This is from Sarah, whose subject is Buy That Dream Retirement Home. Okay, so Sarah's dream retirement home is priced under about $600,000. It's an hour away from where she currently lives. So she goes on to write, I have enough money to make a minimal second home down payment, about 10% down. This would mean in the short term, I would be taking on a 30-year mortgage. So she's 52. She says 30-year mortgage puts her at 82. I don't have a face on that. And she said, I would refi if the interest rates dropped in the next 5 years. I own my own home, which we are keeping for now. When the current home eventually sells, I would essentially get about $400,000 net out of the proceeds. I would have that money to put towards the new retirement mortgage, which would mean I would have it paid off way before I turn 82. I don't really care if you have a mortgage at 82, as long as it's a low interest rate. That I don't have any issue with. Sarah says, I'm on track to have $3.5 million of my own money in pre-tax accounts by age 65. I'm a high-income earner, no Roth. I'm not going to claim Social Security until I'm 70, about $5,000 a month, maybe $4,000 if Social Security gets cut. My husband has his own retirement accounts, about $2.5 million by his age 65. I don't see him ever retiring. Okay. I plan to retire at age 65, take on a low-stress part-time job to keep a little income flowing for extra, just for good measure. My question, should I roll the dice and buy this house? It's located in an extremely desirable real estate market by the coast in New England that is not being affected by the current environment, so the market should not go south there. It has doubled in price in the last 5 years, which, by the way, median home price is up 45% in the last 5 years. Okay. Sarah goes on, if worse came to worse, I can always sell it or downgrade. I'm not going to lose the money. And I also am considering renting it periodically for the next few years, blah, blah, blah. With this purchase and a recent increase in salary, I should be able to cover bills in both locations without compromising what I'm putting away for retirement. Monthly expense is $6,500. My thought is, you only live once, like the kids say, right, Sarah? YOLO. Anyway, she says, I think I'm in a strong enough position to take the leap. I've always have dreamed of living in this town. I worry that if I wait to stash more money away for another 5 years, housing prices could go up by another 25, 30, 50%, which would put it even further out of reach. I hope this is enough detail. This is perfect detail. Look forward to your thoughts and Mark's as well. Okay. So, Sarah, go ahead and buy your house. Calm down. I'm not worried about it. Seems like you have plenty of money. Your monthly expenses are pretty reasonable. And I don't think housing prices are going to go up by 25 to 30 or 50% in the next 5 years. I really don't. However, you want to get the house. Get the house. You got a lot of money. You seem to break up the money between you and your husband. But if you have $6 million between the two of you, I think you're going to be fine. Mark, any issue with Sarah buying her quote unquote dream home?
No, she answered it for me when she said she's still going to be able to cover all her bills in both locations without compromising what she's putting away for retirement. For me, that's the big thing. If you can pull this off and not sacrifice any of your retirement savings, then you can do it.
Do it, right? And also, if you're also saying, like, if something were to go south, I would make an adjustment, great. That seems fine to me. Okay, let's move on. This is a nice thing that from a question from a frugal Gen Zer. Anonymous is 24 years old, a college grad. I rent a one-bedroom apartment. I drive a 15-year-old car that needs to be replaced within the next 2 years, maybe sooner. Full-time job paying $50,000 and also a new part-time job that pays $18 an hour, $1,300 a month. It took me nearly a year to find an entry-level job in my degree field. All right. Monthly expense is $2,000. No debt. $17,000 in unused 529 funds, undecided about grad school. I contribute 10% to a traditional 401k. I have $69,000 in a regular savings account. I purchased $5,000 in I-bonds when the rate was 9.62% and $10,000 in a Roth. The reason I started investing at age 19 is because my mom became an avid listener of Jill on Money during the pandemic. It was hard to escape your unsolicited advice. My know-it-all younger brother recommended investing Roth funds in SCHD. Let's look. That looks like a Schwab thing?
Yeah, it's a Schwab dividend
Schwab
equity.
U.S. dividend equity ETF. Okay, got it. Was this good advice? It wasn't bad. It's not the worst. It's cheap. It's fine. Whatever. It's fine. It's not. So was this good advice? Sure. Any index fund is fine. This is fine. It's okay. Setting up a high yield interest savings account sounds intimidating. And my tax preparer said if I earn more interest, it will have to be declared. Oh, well, your tax preparer is a moron, but let's get back to that in a second. I'm frugal, but unsure how to invest and diversify. Any financial or career advice would be greatly appreciated. Let me start with number one. Number one, stop putting money in a pre-tax 401k. Do not use a traditional 401k. If you have the option, please put the money into a Roth, okay? Stop using a traditional if you have the option. If you don't have the option, just put whatever you can up to that, wherever you get a match, and then put the rest in your Roth, okay? That's number one. The unused funds in the 529 plan, I guess we'll hang on to that until you decide about grad school. Don't be in such a hurry to go to grad school. I don't think it's a great idea. If you have a job and we are going to see the economy slow down, if we were to go into a recession, don't go hide out in grad school. Keep working as long as you can. Stay working. And by the way, good for you. You have a full-time job. I get it. It took a long time to find that job. Keep that job. And if that part-time job is distracting you from your full-time job, then stop doing it. You have to try to keep your hands in this job and make sure that you're doing everything you can to advance yourself. That's your career advice. The I bonds, Mark, should she sell her I bonds? They're not paying 9.62% anymore. So that she probably bought them in 2021. They may not be fully matured, but despite what your tax preparer says, paying higher interest, even if you pay tax on the interest that you earn in a high yield savings account, as opposed to that regular savings account, so what? You're still ending up with more money. That's insane advice. So 2 things, which is definitely you look to a high yield savings account. I guess we should keep the money in savings right now until you determine whether you need a car or not, and like how much that car is going to cost. Maybe consider selling those I bonds. I think Mark's going to say yes. Is that right, Mark?
I would. I have.
Yeah, I already also redeemed mine. Again, it's going to create a tax liability. And if you want to just, the Schwab U.S. Dividend Equity Fund is absolutely fine. You can also choose just a plain old index fund. If you want to add one more fund, maybe you want to add an international fund, like put some small amount, and maybe it'll be like 90% in this U.S. fund and 10% into an international fund, and don't worry about it. Sounds like you're in good shape, Anonymous. I'd be happy to be in your shoes, and just keep that job, okay? If you have something going on in your life that remotely touches your financial life, and most things do, get in touch with us. Go to JillOnMoney.com, click the Contact Us button, and write us a note. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, the program that is trying to help you make better financial decisions, or maybe less bad ones. And for some of you, this is a very intimidating topic, your money, your finances. But I would suggest to you that given that we are halfway through the year, now is an ideal time for you to really think about what happened in the first 6 months of the year. How did you spend your money? Have there been some life changes? Did you get married or divorced or had a baby? Did you receive a new diagnosis? Did you get a new job? All of these issues, your real life issues, will impact your financial plan. And if you don't know where to start with any of those big life changes, those milestones, get in touch with us. Go to JillOnMoney.com, click the Contact Us button, write us a note, and we would be so happy to help you out, because really this is the most fun part of what Mark and I do every single day. It's talking to you. And so we are here for you, whether you have a very little money, whether you have lots of money, as long as you have an issue that needs to be resolved or something you'd like to think about. That's really the critical factor here. What it is that you need. Again, go to JillOnMoney.com, click the Contact Us button, write us that note. While you're on the website, don't forget to check out all the content that lives there. We've got a nice resources section. There are some calculators there, maybe for some retirement planning. We've got a blog. You can catch the latest segments that I've done on CBS News in the video section. Of course, there's also links to my books, The Great Money Reset, as well as my first book, which is called The Dumb Things Smart People Do With Their Money. You know, those books were inspired by you, my conversations with you over these last many years. Oh my God, it's almost 15 years since we've been doing this show. Know that your conversations with us, your emails, they have been really important for me to figure out how to best look at content that you want and you need for your financial lives. Right now, let's talk to Don, who joins us from Detroit. Hello, Don. How can we help you today?
Hi, Jill. Hi, Mark. Hey, thank you for taking my call.
Sure.
I just turned 60 recently, And I'm wondering the age-old question, do I have enough to retire?
First of all, congratulations, Mazel Tov on 60. That's great. So hooray for you. And
Thanks.
you're working right now. Are you happy in your work? Like, how are you?
Um, I'm starting to get to be over it.
Dude, I am with you. I can't believe I'm saying this. You know me. I'm the one who's on this podcast saying, "What are you going to do if you're 60 and you're not work?" But I mean, I can understand getting over the drudgery of it and then thinking about what is next. What's your off ramp? Are you partnered? Are you married? What's going on?
Yes, married. Actually, today is 25th wedding anniversary.
Oh my
And
goodness.
yep.
Amazing. And how does the spouse feel about you maybe calling it quits?
She's all for it.
She is because you're grumpy.
Yep.
Are you grumpier? Tell the truth right now. Are you like, oh, stop bringing your work home with you? I don't want to hear about it.
No, it hasn't gotten to that point yet.
Okay. Is she working?
No, she isn't.
And you guys have kids?
We have one daughter who is through college and not fully launched, but on her way.
Okay. And does she live with you?
Yes.
Okay. But you feel like when you say not fully, like you feel like she's going to leave the house soon. Like, do you need to help her financially besides giving her the housing?
No, not really. She's pretty much on her own.
Okay.
She has a full-time job and she's starting her career.
Okay.
So
That's great. How much you earn?
140.
Okay. On that 140,
Yep.
you've saved a bunch of money. So tell us about what you've saved.
In my 401k, I have 1.65 million. Approximately 10% of that is Roth. I have my own Roth IRA at 234,000.
Okay.
A brokerage account, 232.
Okay.
Our work also has a results-based pension plan. I think it's a 401A, and that has 110,000. Spousal Roth is 45,000, and a HSA account of 33. And lastly, an inherited IRA for 12,000.
And then like savings account, checking, CD, safe money?
That's right about 50,000 right now.
Okay. How about your house?
It is paid for a couple of years ago. Zillow tells me around 475.
Do you want to stay there? Is that like a place where you want to stick around? You love those Michigan winters, right?
Kind of on the fence on that. I'm about 50% stay there, 50% head south.
Okay.
So I'm not real sure.
I have a couple of follow-up questions. That pension, the 401A,
Yes.
is that a cash balance? In other words, when you retire, does that or does that actually turn into a stream of income, or do you have the choice?
You know, I'm not 100% sure, and they give us a benefits guide once a year, and they estimate it to be about $977 a month.
Okay.
But I don't have any other specifics on it.
All right.
So
You ready for the hardest question yet?
sure.
Brace yourself. How much
Okay.
do you guys spend?
I don't have a great handle on that, but I'm gonna estimate about 7,500 a month.
And do you feel like that really accounts for everything? If I said 9,000, would it be like, oh no, we don't? I bet it's more than 7,500.
Actually, I think it's gonna be less than 7,500. I put a little bit of cushion in there.
Now, fun thing. Let's say you want to give your notice. What does that entail for you? Do you have to work a certain period of time? Have you been in this place for a long time and you're like, no, I mean, I need to give them many months. Like, what's the process for you?
I've been here a long time, over 30 years.
Wow.
So it's been a while. I'm not familiar with the retirement process or early retirement, so I guess I need to get educated on that.
We'll get back to Don in just a minute. If you've got a financial question, it's very easy to get in touch with us. Go to JillOnMoney.com, click the Contact Us button, and write us a note. You are listening to The Jill on Money Show.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Welcome back. It's Jill on Money, the program that is trying to help you figure out where you want to go and what options are available to you. And this is a program that is grounded in a specific approach. Mark and I are both certified financial planners. We don't do it for a living. We do this media thing for a living. But when you are talking to someone who is a certified financial planner, there is a more holistic approach to a process that is really ingrained in us. And I think that's very different than a transactional approach where someone's trying to sell you a product and then they're back-ending this with a financial plan just to sell you the product. In that situation, sometimes it's hard to decipher whether this person is really trying to sell you something or help you figure out your overall financial plan. With us, you don't have to have that worry. We are just straight up interested in talking to you, learning about what's going on, trying to help you figure out how to get where you would like to go without selling you anything, except maybe a $45 subscription to Jill on Money Live or a couple of books. That's about it. That's all we got to sell here. So again, if something's going on, if you've got a retirement question, a college funding question, a real estate question, anything that is on your mind, you can go to the website JillOnMoney.com, click the Contact Us button, write us a note, check the box if you'd like to join us live. And speaking of that, we've got to get back to Don, who's patiently been waiting for me to stop yammering. Don is joining us from Detroit. Let's say that you want to be done by the end of this year. Okay, let's presume that. So then what happens is you give your notice and we need to make sure that you've got $7,500 a month of income, which I think is pretty easy to do because you've got all of that money, that 1.65 million, or let's call it 1.5 that hasn't been taxed yet, right? And you can just pull money out of that account. Essentially for 10 years, you can really, that's going to cover what your need is for the near term. And then do you have any idea what your Social Security benefit looks like?
Okay, at 67, it's 3,800. At 72, I didn't write the number down, but I want to say it's around 4,200.
All right, I won't even make you wait till 70. Okay, so let's say it's 3,800 at 67. So you see where your problem is. It's not a problem. You can retire. You're fine. You're totally fine. Don't even think about, this is not a big deal. But your only big deal is that you have this $1.5 million that hasn't been taxed yet, right?
Uh-huh.
And so what I would suggest is that for whenever you decide to retire, whether it's the end of this year or whatever happens next, okay, that you would take money out of that traditional form of savings. So maybe it's, again, I have no idea really how much money you're spending because when you say 7,500, but that's overstating it. But let's say that that's right. You basically can use your 401k that has not yet been taxed to provide you with that $7,500 a month of income. Okay. Now, maybe you're not going to have to take out as much because maybe that 401a turns into like a nice pension benefit, but we don't really know. I don't know if that kicks in immediately. I don't know if you have to wait till you're 62 or 5 or something. Sometimes they have rules about when you can claim that. But if you think about it, you have the money that you need to live on. And then you won't have to touch the Roth IRA, the brokerage, the spousal Roth. You will essentially let those things grow so that by the time you hit 67 or 70 and you get your Social Security, those things will have grown enough so that your benefit, and I get your wife is claiming half of yours, right? That's
Yes.
how we're going to do it. So
Yes.
is she your age?
She's a couple of years younger than me.
Okay. So she will eventually be able to claim half of your benefit. And I think you're fine. I mean, you're not like you're not in a place where I could say you could do anything you want. You can spend $25,000 a month. But for what you've laid out, I think you're absolutely fine. If your numbers are if you want to beef things up a little bit, if you said, well, I'm kind of over it. I know I could do it, but where does it look a little better? I think that if you worked like another couple of years, it would look a little bit better just to build things up. But it's not, I don't know, like you've got in the Roth assets and the brokerage, you have 2, 4, 5, 6, like almost 700, 650 of assets that will just you're not touching, which can keep growing. So if you think about that over those years, you'll have at least probably $1 million, maybe more by the time you get to be 67 or 70 from those assets. So you then have Social Security, and then those assets have grown. And then when you pull money out of those assets, there's no tax due. So you can just take the money clean, like the $5,000 a month that you need. It'll be fine. It'll be $4,000 or $5,000. It'll be fine. But if you wanted to beef things up a little bit, then maybe you would say, oh, let me see, because maybe I'd like to see get this kid launched, make sure I have a little extra money, then it might look a little bit better. Really comes down to how much you dislike what you're doing or how over it you really are. Is having the knowledge that you could do it, as long as you're careful about the spend, is that enough to get you through another year and then you reevaluate? Or do you just be like, good, I'm done?
It definitely helps, yeah.
Now, I'm going to tell you what my friend Michael likes to say. And he always says, you are now part of a very special club. And that club is you're one bad meeting away from giving your notice. If you've got a question, all you have to do is go to the website JillOnMoney.com, click the Contact Us button, and write us a note. If you'd like to join us live, check the box. Mark will do everything else. You're listening to The Jill on Money Show. Welcome back. It's the Jill on Money Show. We are here answering your financial questions. If you have one, all you need to do is go to our website, JillOnMoney.com, click that Contact Us button, and write us a note. And then, of course, we would be delighted to have you join us on the air live. And when you join us live, the experience is a little bit different. I think for us, it's different because we can ask you immediate questions as follow-ups. It also can be really important because maybe you're going to forget something. Maybe you're going to insert something else in your thought process that's not on the actual original question. And I think that's why it's so valuable. So please, if you're shy, we'll change your name, we'll change where you're from, we'll protect you. JillOnMoney.com is the website, Contact Us button. Before we finish the program, this is a message from Tim, who writes, I listen to your show regularly, and you always hear the do you have a pension question. My question, says Tim, is I have a cash balance plan which has a lump sum or a monthly option. It has no cost of living adjustment. So is this considered a pension? Without a cost of living adjustment, it concerns me, and I'm thinking maybe a lump sum is best. Tim, this is a great question. I think we'd have to really understand the details of the plan and how the pension calculation would impact you over time. And also, to answer this question properly, we'd have to understand the other resources you have. Maybe it is better to take that lump sum, but maybe a stream of income for some portion of your retirement assets would also be helpful. All of these things require a follow-up, and I'm sorry, I know that's a pain in the neck for you. All right, that is it. That is the program. We are so happy when you join us every week. We really value that. If you missed any part of the show, just go to JillOnMoney.com and you can click the radio section. JillOnMoney.com, click the Contact Us button, write us a note, check the box if you'd like to join us live. Our music is composed by Joel Goodman. Mark Talercio is our executive producer. He's also the king of all things web, JillOnMoney.com, that is. We ask that you do something nice for someone else today. It's going to make that person feel better, and it's going to make you feel better. Change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you next week.